So, with this vital context established, let's talk about how the narrative of the market changed. For years, the story of the stock market was written by the giants, the banks, the hedge funds, the institutions, insurance companies. Wall Street often dismissed individual traders as dumb money, assuming they disappear when things got tough, especially during volatility. 2025 was the year the narrative died a decisive death. It was the year of retail revolution. We saw individual investors not just participating, but dominating market sentiment, providing essential liquidity, and in some cases, even rescuing the barter market from major institutional sell-offs. Think back to April. Today, we look at the hard data, the behavioral shifts, and the sheer capital that made 2025 the undisputed year of the retail investor. We'll cover 4 key topics. How the volume gap between retail and institutional effectively vanished, the explosion of AI integration in personal trading, the unprecedented buy the dip resilience that stabilized the market, and the massive impact of options trading, specifically zero-day option trading. Jump right into it. So, a little context: retail versus institutional, closing the gap, right? Before we get into the stats, let's figure out who the players are. Institutional investors, they're the giants. Pension funds, mutual funds, insurance companies, usually managing billions or trillions of dollars for others. They have massive research teams, high-speed data feed, and direct access to the markets. Retail investors, on the other hand, they're, individuals like you and me, buying for our own personal goals in retirement, a down payment on a house, or generational wealth building. Historically, we're the perennial underdog, relying on quarterly reports and news cycles. But in 2025, that gap in influence and volume effectively vanished. The data is staggering. The stats: retail activity hit all-time highs. Over 1/3 of total U.S. equities orders flowed on April 29, 2025. Think about that. More than 1/3 of the total market activity on that volatile day was driven by individual accounts. Throughout the year, retail participation reached its highest sustained level in history, with individual retailers consistently accounting for 20 to 25% of average daily U.S. trading volume. Why does this matter? Volume is power. It provides liquidity, determines price discovery, and influences institutional strategies. When retail volume consistently equals that of hedge funds, Wall Street has no choice but to take notice. The dumb money is now a structural, permanent feature of the market landscape.